Good afternoon, everyone. If you're not familiar with Marin, he's one of the premier resource financiers over the last 17 years. We've raised a couple $2 billion in equity, and we run a private equity fund. Most of it's his money, some of it's Doug Casey's and a few other high net worth guys. It's a couple $100 million under management. The other thing we do is we run a retail newsletter subscription, caters to anybody from the savvy fund manager all the way down to you're buying your first resource stock. So we pride ourselves in our education. And when I took a look at all the speakers for the conference, I saw no oil and gas companies or speakers. I went, well, that must mean one of two things. Either there's no buyers and everybody's selling, or this is a really good opportunity. And being an oil and gas analyst, I figured, okay, well, let's spend 20 minutes walking through what's happened over the last few years and what Marin and I see moving forward in the sector. So if you're new to oil and gas, the oil and gas sector is enormous. It's much bigger than any of the individual commodities. So if you look at iron ore, for example, it's a $150 billion a year industry. Well, oil is 1.8 trillion. So you're looking at over 10 times the size. It's a huge market. And if you're an oil and gas investor, I'm sure you've seen this chart. And if you're not, well, you've come to the right place because you're going to get some good discounts. So this is what's happened to the price of oil over the last 10 years or so. And you can see just before the financial crisis, oil was $140 a barrel. We had the financial crisis, demand cratered, and oil prices broke below $40. So that was a 60% decline in like under a year. It was carnage. Then you had a really nice rebound in oil prices through QE, and some of that money trickled into what we now know as the shale revolution. Anybody know that? Horizontal fracking, all that stuff, right? And so the Americans became pioneers in the way they extract hydrocarbons through horizontal drilling and fracturing. And that was great until about 2014 and 2015 when they became a really serious player in the industry. And I'll show you a chart in a little bit of the actual growth that the U.S. has gained over the last few years. But one of the main reasons why the oil price crashed there was because there was so much excess supply due to the United States. So if you're unfamiliar with OPEC, OPEC is the oil producing exporting country cartel. It's 15 countries, give or take Qatar if they're in or not, that essentially have controlled the market for a long time, for decades. And they've been the most important player in the industry, and they don't like giving up market share. So in any event, OPEC didn't like to give up any of their market share, and they said, okay, well, how can we combat this? Well, at the time, shale oil production was really expensive. So to produce a barrel back in the day, it was a little bit better than profit-wise than a science project. It was probably like $75 or $80 a barrel. So when oil prices were 120, great profit margin. But OPEC produces oil for much lower costs. I mean, you're talking like $8 to $10 a barrel all in. And so the Saudis who run OPEC said, okay, well, the best way to combat this is to increase our production. So that's why you'll see there between 2015 and 2016, there I've got OPEC pumped at will. And so essentially what they tried to do there is they actually tried to increase production as much as they could to bring the price down on purpose. And while the Saudis may not tell you there was two reasons, I'm pretty sure there was two reasons. One was to combat shale, and they were going to try and drive out any of the high-cost shale producers, which they did. So many companies went bankrupt. What they also did was they ended up driving out a lot of their own competitors from OPEC. There's a handful of nations within OPEC that can't produce for $8 a barrel. A country like Venezuela needs much higher oil prices to balance their budget. And so what they actually ended up doing is they ended up actually squeezing some of their own counterparts out. So it was a little bit of two sides to the coin. Shortly thereafter, the shale companies went into hibernation, and they said, okay, well, we've got to learn to be efficient here. We have to learn how to make money at low oil prices. We've proved this is not a science experiment anymore. We need to make this a reality. And how do you do that? Well, you have to be able to produce oil and gas at $35 or $40 a barrel, all in. If you can't do that, you're not going to be able to compete anymore. And I'll explain that later. So they went into hibernation, and they began to innovate. And now they're extremely technologically savvy. And OPEC realized this and said, okay, well, if we now we want to do two things. We either want to balance our budgets, or we're going to have to continue to pump at will. And they didn't think pump at will was going to work. And so what they did was they started to cut their production. We've seen that a couple times. They've cut 500,000 barrels or 800,000 barrels, and they've done that twice. And at the end of 2018, they agreed to cut another 800,000, and the Russians are going to cut a little bit in Mexico and so on. So long story short, we've come through a pretty serious last 10 years of turmoil that has left a lot of oil and gas companies, especially in Canada, pretty hamstrung. And so it's an interesting perspective now to come in and say, okay, well, if you've survived this long, is it a huge opportunity? We're buying something at a decade low that has a good chance to rebound, or is it going to go bankrupt? And there's going to be a lot of both. So this tracks energy sector fund flow, which is essentially all the buying and selling that happens between ETFs within the oil and gas industry. So like your XLE in the US or your XOP are two really good examples. And so you'll see that there's only a couple times in history where we actually had negative fund flow. Most of the time it's positive. And so this is a really interesting sentiment indicator that you want to look on the other side of. You don't want to be buying stuff at peaks in 2014 when oil was $140. You want to be buying in depressed markets. So this to me tells me that the generalist fund flow is actually quite negative, which is good. Really quickly, this is oil market supply and demand. If you haven't seen it before, this is roughly what the global market looks like. In 2013, oil demand and production was a little over 90 million barrels per day. Now we're forecasting about 100 to 101 million barrels a day this year in 2019. It's like 13% increase. And it's grown more or less in lockstep. And what you'll see, the bottom chart there is the surplus and the deficit, which is the difference between supply and demand. So what you have to think about is we always produce a little bit more than we need to, which is okay, and we just store it, and it's not a big deal. Because a lot of the headlines that we see in Bloomberg and CNN and whatnot are all about oil inventories. I'm going to explain to you how you should actually be looking at these. So really quickly, this is the supply side like I talked about earlier. Who knew that the US was the largest oil producer in the world right now? 11.7 million barrels a day. They're the largest oil producer in the world. Russia's number 2 at 11.5. Saudi Arabia's number 3 at 10.7. What you can see, though, is the growth rate is exceptional in the United States, and that's because of the shale revolution, right? So they've grown 67% since 2013, whereas the Russians have kind of not really done much. They're up 10%. And Saudi Arabia is up 17%, and so that speaks to that point about me talking about how some of the other OPEC nations were too high cost, and so they had to cut their production. You can see that with OPEC's production is only up 4%. So somebody had to take that extra little bit of market share, and it was Saudi Arabia. So global crude inventories, this is a number that you'll see get flashed across the screen. Usually it's only the American inventory, which is not actually that helpful because oil is a global commodity, so you need to look at it on a global basis. So this is the amount of oil currently held in floating storage and whatnot, and that's in billions of barrels, so it's about 5 billion barrels. But that's just a number, and that's not really good enough. What you want to look at is you want to look at that relative to demand, because if you have more supply and less demand, you actually have a worse market. And so this is what the IEA represents as their days of supply. So this is inventories divided by consumption. And you can see that it's kind of stayed in this range of 90 days, went up to 100 when things were very oversupplied. I have a big problem with this data, and that's because it doesn't include China. It's odd that this would not be included in a global model. So this is our Katusa Research model, which of course we assume is better than everybody else's. Little different scenario now, right? So this takes all of our OECD data, consumption data, but you include something like China, which is the second or third largest consumer of oil in the world. They consume 14 million barrels a day. You have to include that in your consumption model. It's enormous. And so you can see there that the inventory levels, not only is it not just 90 days, it's actually decreasing. And so I put the two together here, and it's a pretty stark difference. If the chart was going the other way, if the red line was going up towards 56 or 60 days, I wouldn't be standing up here having this discussion. I'm not going to pitch that oil is going to $150 a barrel tomorrow. But what I am saying is that there's probably a floor here in this $40 to $50 range, and I think you can use that moving forward as sort of a buy under level. So when we look at oil, you want to look at what price your oil producer is actually getting for their barrel. So the WTI price, which is the black line, is the West Texas Intermediate price. That's the one that you see every day quoted on Bloomberg. That's great, but that's actually not representative likely of what your oil producer actually is earning on a revenue basis per barrel. So the red line is the Edmonton mixed sweet barrel, and the green line is the Permian Basin. So there's two different oil prices there, and you can see that they're not the same as WTI, and that's usually due to a transportation issue. Especially so, the red line there, I'm not sure if you can see it on this side, but there's a really dramatic spike lower at the end of 2018, and that's because we were well oversupplied in Canada. So we end up with this pipeline debate of we can't get our oil out. Well, this is an extremely easy way to represent to Justin Trudeau that our oil companies are losing a pile of money because we don't have the pipeline capacity. If we had the pipeline capacity, we would be earning the same per barrel as the WTI price or the Permian Basin. The Permian Basin has its own logistical challenges, but very minimal in comparison. I'm not going to dwell on this too much because Rex Murphy covered it quite well yesterday in his talk. I hope you saw it. But this is essentially where Canada's at in terms of their pipeline situation. We've got a little bit of takeaway capacity right now, but we're oversupplied. And that red line there is our production curve moving forward into 2030. And then you've got 3 or 4 different pipelines that have been failed or delayed or whatnot, and it's a total mess. The saving grace, and there is one small positive, is the delayed pipeline is actually going to come online. Ironically, it was actually slowed up on the American side of the border rather than the Canadian side, but that's going to provide a little bit of respite at the end of 2019, beginning of 2020, which should help the Canadian prices recover a little bit more. In comparison, this is the Permian Basin. No shortage of pipelines here, so this is every bar there represents a pipeline. And whenever they have a problem, they have access to capital and access to permitting that we definitely do not have. And as you can see there, they have no problem in terms of takeaway capacity. The black checkered line there is sort of our production forecast. And you can see that they're basically fine way out into 2022 plus, which is more than enough time. We primarily are looking at onshore shale basins because it's the cheapest place to produce oil around. And so you'll see here that we've got blue and red bars. The blue bars are the American formations and the red bars are the Canadian formations. And the important part here is that all of these formations can break even below $50 a barrel. If you can't produce oil for less than $50 a barrel, you're not going to be able to compete moving forward. This chart shows our performance of Canadian oil companies versus the American companies over the last few years, and you can see that the Canadian guys have really underperformed, not just once, but twice. So in 2016, all these companies got crushed, and then in 2018, especially towards the end of the year, the Canadian oil producers really got hammered really badly, and you had companies go down 50 or 60% in the span of a couple of weeks, and that's pretty significant for a company that's actually producing cash flow. And we're not talking like a $50 million junior. We're talking about a company that produces 100,000 barrels a day. This company was $45 in 2010, and now it's $4. So you come up to this dynamic of, okay, is this company worth anything, or is it toast? When we measure oil and gas, we want to look at different ratios to help us make that decision of, where are we at in the cycle? And this is a pretty good representation of how companies are valued relative to their cash flow. And you can see here that we're basically at all-time lows, if not the last 15 years or so. Black is the oil-focused cash flows, and then green is gas, and yellow is the senior producers like your Suncor and stuff like that. And they've all been hammered, but especially the oil-focused guys. This is another way we can look at it, and you'll see this metric very common. It's enterprise value to debt-adjusted cash flow. So this accommodates for the debt that all these oil companies have on their balance sheet. And this is an important slide. This measures debt to cash flow. So this is a company's total debt measured against the cash flow that they generate. And you can see in 2014 and 2015, the line was going up. And that's actually quite bearish because it means they have more debt relative to the cash flow. Now this has come back down over the last couple of years because these oil companies have either refinanced the debt or gone bankrupt, in which case they're not on the chart anymore. But the more important part is these guys now have a little bit more runway than they did in 2014 when their back was against the wall for the first time when oil went down to $35, $40. So this is a good situation. If these, once again, if these ratios were upwards of 3.5 or 4 times debt to cash flow, we wouldn't be having this conversation. So what I wanted to leave you with before I take any questions is something that you're not going to get from any other research report. And we always try to add value when we're at these conferences. And this is an all-in cash cost per barrel for each of the junior and mid-tier producers in Canada. And you can see these lines here. So black is the royalty. It's essentially like the tax that they pay. OPEX and transport, that's a fixed cost of production. And you have G&A and interest. And that's an important one because a company that has a lot of debt is going to have an issue. And so you can see that that's represented there in the green line. Yellow is CapEx, and the purple is the dividend. And there's not too many companies left that are paying a dividend. So this is a good value add slide here, and I encourage you all to take a look at it and visit our website where we've got a lot of great information, not just on the oil sector, but on the resource sector itself. Thanks, guys. Enjoy the rest of the show.